G'day, it's Glenn here from Precision Wealth Management. Wanted to do a quick video today on the pros and cons of having TPD, Total and Permanent Disablement insurance within your superannuation. A lot of people, most people, have Total and Permanent Disablement insurance within their superannuation by default. But you don't have to. You can apply for a Total and Permanent Disablement policy through a retail insurer away from your superannuation fund. And there are pros and cons of both. So the pros of having TPD insurance inside superannuation is that the premiums are tax deductible. Not to you, not in your tax return, but to the superannuation fund. When you have like an industry super fund and you've got TPD insurance, that insurance is tax deductible to the super fund, and most of the times you don't see that tax benefit. It's included within the investment returns. But if you went to get a retail insurance policy and asked for a TPD policy and the premium was $100 and you paid from your bank account for $100, if it was paid from your superannuation fund, it would get a tax deduction and the premium would only be $85 after they accounted for the 15% tax deduction. The other pro of having TPD insurance inside superannuation is for your cash flow. You're not paying for the premiums from your cash flow. So if you're in your 20s and 30s, you've got a young family, a mortgage, cash flow's tight, but TPD insurance is important, having it deducted from your super is good for your cash flow. The cons of having it inside superannuation though are around at claim time. There is tax on withdrawal if you meet a claim. If you've got your TPD policy inside superannuation and you do make a claim, that TPD proceeds are paid to your superannuation, and there is tax payable on getting the money outside of superannuation. There's different things you can do to minimise it and potentially get away with not paying any tax at all, and I've got other videos around that, but there is potential tax issues around claim time if it's owned by superannuation. If you've got a TPD policy just owned by you and you pay the premiums directly to the insurer, then if you meet a claim, the TPD proceeds, generally speaking, are paid to you without any tax implications. The other cons on TPD inside superannuation is around the definition of the TPD policy. And that is most commonly around the any occupation definition or the own occupation definition. So broadly speaking, there are two different types of TPD policies you can have. One's an any occupation, and that means to get a claim, you need to be totally and permanently disabled to the extent that you can't work in any occupation. Or alternatively, the better definition is the own occupation, and that means that you need to be totally and permanently disabled to the extent that you can't work your own occupation. So for example, if you're a carpenter and to do your own occupation, you obviously need to lift and carry and whatnot. And if you have a permanent shoulder injury that prevents you from doing your own occupation, you may be eligible for a TPD payment if you've got an own occupation definition. But if you can do another job, say work at Bunnings or drive an Uber, then if you've got an any occupation definition, you potentially won't be paid the claim. Inside superannuation, you can only have an any occupation definition because that aligns with the superannuation definition of disablement to access your super. So what you generally have inside the industry funds are all any occupation type definitions. All retail insurers now offer a product where you can have any occupation premiums paid for from your superannuation fund, and then you pay a little bit extra from your cash flow to have the better own occupation definition. So they split it up. They split the premiums up. Where you do have an own occupation definition, you can get the benefits of having any occupation paid from your super fund, then you pay a little bit extra. So that really gets around that con. Now, what would you generally do? Well, the pros of it being the premiums being tax deductible versus the cons of the tax on withdrawal. Generally speaking, you are better off to have your TPD insurance inside superannuation and get the reduced premiums from the tax deductibility of them. But you may consider grossing up the amount of cover you've got to take that into account. So for example, you think you might want $1 million to cover off X, Y, and Z in the event of a claim. Well then, to get around the potential issues here, maybe you increase the cover to 1,100,000 to cover off on that, and you're still better off because of the deductibility of the premiums. So I hope that gives you a bit of a rundown of the pros and cons of having TPD inside super. Just because most people have an industry super fund and they've got TPD in there, that does not mean that's how all TPD insurance works. In fact, there's a massive world out there of retail insurers that generally offer better products, better definitions on the TPD policy. And also, when you get a TPD policy from a retail insurer that can be paid from your super fund, it's not linked to your super fund in the sense that you don't have to stay with that super fund to keep that particular insurance, which is kind of a really important thing, particularly for people a bit further down the track. If you're considering keeping your super fund or not, if you've got that insurance that's linked to that super fund, sometimes you're stuck with that super fund if you can't get insurance elsewhere. Anyway, I hope that makes sense. If you need any more help, please get in touch.